Welcome to what we call the Wealth Confidence Allocation, or WCA. The Wealth Confidence Allocation provides confidence to invest in order to achieve a financial goal, whether retirement or other financial objectives, to invest at virtually any time, regardless of what the economy might be currently experiencing, and to outperform a traditional investment approach with far less risk. WCA transforms the traditional way of investing, which we term as linear investing, into a nonlinear structure. When most investors invest in a stock or a mutual fund, they invest in a linear structure. In this example, we use a fund based on the S&P 500. When the market increases, the investor's investment increases in value. When the market decreases, the investor's investment decreases in value. Pay attention to the blue line where we structure the investment to increase when the market increases, but mitigate the loss of value when the market decreases. As the blue line indicates, we can structure it so there is a point where the investor outperforms the stock market when the stock market increases. Even when the stock market decreases, there is a point where we may structure the investment to increase in value. We will return to this example and how we do it later. But why is this important? Investments can provide financial security, help reach retirement, or achieve other financial goals. However, unpredictable events lead to uncertainty of achieving those financial goals. Sometimes these events are called black swan events, indicating that they are a complete surprise. The problem with these events is that they often have major economic effects along with being unpredictable. In fact, the smartest people in the world can't predict these events. The economist John Kenneth Galbraith observed, there are two kinds of forecasters, those who don't know and those who don't know they don't know. The events may include recession, pandemic, trade war, 9/11, tsunami, or other catastrophic events. These events all negatively impact the economy and your investment. Whether triggered by a black swan event or some other reason, human emotions often lead investors to react and do the wrong thing. For example, J.P. Morgan shows how the average investor dramatically underperformed other assets and investments, and further states that the main reason is because of emotions triggering investors to make poor decisions. More money may be lost due to fear and greed than all of the financial, economic, and geopolitical events combined. It's not the events themselves, but our response to the events that can cause the greatest harm. In addition, several studies show that the average pain from an investment loss is double the amount of pleasure from an investment gain. For this reason, investors often try to time their decisions with the belief that they can limit or remove the possibility of losses, but they are simply not successful. Investors often say the following to indicate their concerns. Do you ever say the following? The WCA effectively reduces the impact of these events and emotional challenges by structuring the investments to transform the investment from a linear structure to a nonlinear structure, avoid emotional decisions, protect capital against the negative effects of unpredictable black swan events, and achieve financial goals. Back to the prior example. Having the right structure can dramatically impact the success of reaching the financial goals. Since the black swan events are not predictable, but they have tremendous negative results to an investment, it is more important to have a nonlinear structure. How does this compare to a traditional allocation? The following shows a traditional balanced allocation with 50% in fixed income and 50% in the stock market. For roughly the same targeted return, the WCA has only 8% in the stock market, but 92% in fixed income. Which one looks like it would have more risk? The traditional allocation has more risk because of the larger stock market allocation. In fact, if the market decreases by 30%, the entire portfolio is estimated to lose 12% of value, whereas the WCA portfolio loses approximately only 3% of value. Another example shows the same 50-50 mix between fixed income and stock market exposure compared to WCA portfolio with 12% in the stock market and 88% in fixed income. If the stock market decreases by 30%, the traditional allocation decreases by 13%, while WCA decreases only 8%. On the other side, if the stock market increases 30%, the traditional allocation portfolio increases 20%. while the WCA portfolio increases 23%. How do we do this? The main structure combines a diversified portfolio of fixed income investments with a 2+ year call option on an S&P 500 ETF, identified with the ticker symbol SPY. The equity options will fluctuate in value, but you know what the maximum amount you can lose, which is far less than the traditional allocation. The fixed income investment will also fluctuate in value and there is risk, but the risk is usually less than the stock market. There are several rules about how to create the structure, but the main rule is to roll or extend the options at the 1-year anniversary date. There are times when the market increases or decreases enough to warrant resetting the levels and move the curve up or down. For example, if the market significantly increases, an investor can sell the option and buy an option at a higher price, thus trying to protect much of the realized gain. Conversely, if the market significantly decreases, an investor can sell the option and purchase an option at a lower price to change the curve downward, thus taking advantage of the lower market. Clients who use WCA are very familiar with the Bill and Bob story. Bill is an optimistic client who uses WCA, whereas Bob is an optimistic investor who doesn't use WCA, but invests in an S&P 500 mutual fund. At the beginning, both Bill and Bob enjoy the profits and even get to a point of saying, making money is easy. But their emotions change when the market decreases. Both investors start to lose money, but Bob loses at the same rate as the stock market, thus a linear structure. Bill knows that he is invested in the WCA structure or nonlinear structure. At a point, Bob questions what is going on and eventually gets to a point when he says, "I've had enough. It is Las Vegas. It is gambling. I never want to be in stocks again." Bob gets out and is unhappy with his losses, but is relieved to be out of the stock market. In the future, the stock market rebounds and Bill is ahead of the stock market to eventually see all-time highs in his investment account value. Bob, on the other hand, is experiencing fear of missing out, or FOMO, with the stock market increasing and his friend Bill doing very well. There are many emotions in this chart, and most of them lead the investor to make the wrong decision. Which one are you? Here are some of the nearly limitless examples of WCA structured payoffs. Notice the nonlinear structure of all of the allocations. If we use just these allocations, let's see where the money is invested. Here we show the amount invested in fixed income and the amount invested in stock options for each allocation. You don't have to be a market wizard. We do it for you. Just give us a call for us to start creating your customized structure. WCA provides confidence to invest regardless of the economy. Peace of mind of not having emotions drive poor decisions. Comfort that unpredictable events will not permanently disrupt your financial plans. Lastly, keep in mind that we don't take possession of your assets. You have your own account at a large institution, and this is not a high-frequency trading strategy. In fact, there are often no trades throughout the year. We look forward to working with you.